On this episode of Keeping It Rich with Sakina, I visit with a top financial consultant to find out if now is really a good time to enter the market. Let's see if he can convince us. Welcome to this edition of Keeping It Rich with Sakina. I'm your host, Sakina Sproul. Today we are at the Big Apple Room at AXA Advisors in Manhattan, and here with me is Hervé Vixamar, who has been an advisor here for over a decade. Thank you so much for entertaining us today.
Thank you. Thank you for having me. I appreciate it.
Sure, I'm looking forward to this. We've done a lot of telephone conversations, people, a lot of prep time with this guy.
Yes, we have.
So I want you to know I came here today on behalf of my relatives and my friends.
Okay. Good.
Okay?
Right.
Really serious information here. I mean, I put on a white ruffled shirt and everything because that's how serious
So
this situation is.
Okay.
This is serious. A lot of people lost a lot of money in the market last year.
Right.
And they want to know, is now really a good time to get back in? Why should they get back in? What do you say?
First, I have to say, Sakina, the thing that you want to understand here is that it's always a good time to be in the market, to be investing for your future. Yes, a lot of people, they lose a lot of money in the market. The S&P 500 was down 37%.
37.
37%.
S&P was down 37%. I just
last
want to
year.
pull out a few things.
Right. So, you know, obviously we saw a lot of bank failures. We saw, we heard about bailout and things like that. So people obviously got scared. They decided to go into cash. But what really has to be the prevailing point here is to understand that you really got to start thinking about, you know, the proper asset allocation. That's where I think a lot of people had problems, is that they went from all or nothing. They went equities, they went into cash, and now they're sitting in the cash. Market is coming back up. Market's up 25% year to date. All of a sudden now, you're still sitting in cash. Now, with proper asset allocation, if they had a good mix of cash, of equities, of fixed income, you could basically scale back from one end to the other. So one of the key things that people need to understand is that they don't necessarily want to, every time they hear something going bad in the market, is to pull out. They really want to be in a position where they can just kind of scale their portfolio based on how things are going.
Okay. All that sounds great. But pretty much what we saw people doing, they were diversified. They had equities, stocks, you know, they were in fixed incomes, they were in bonds, they, you know, maybe different sectors, and they took all the money out of everything. You know, I mean, I have, when I say friends and family, I mean literally, and you guys know who you are who's watching this episode right now, who took, you know, they said, oh my God, I lost $50,000, so I sold everything in this fund that was left and put it all in cash. So while they started out, they were diversified, but then they took the money out and then they put it all in cash. So now there is no diversity at all.
Good piece to understand here is that, again, it goes back to the risk tolerance. Again, one of the things as an advisor I'm always concerned about is, what are your goals? What's your time horizon? When do you need this money for? Right,
very good point, very good
So
point.
one of the things is that when people are doing that, they're doing it out of panic, out of fear, not because they've kind of lost sight of what their goals should really be. The other thing, too, that they need to understand, when the market goes down, doesn't mean that it's going to stay down. You know, the market has a mind of its own. It will go up, it will go down. So the key concern here is to be able to say, well, you know what, the market is down. I want to be able to scale back on what I'm doing, maybe more bonds, maybe a little bit more cash, but not come entirely out. Because now you start timing the market a little bit.
Okay.
So
and if they did actually do it, though, right? Because a lot of people did it. I'm not really mad about the fact that they did it because, say in December '08, for instance, I bought a lot of stock. Well, a lot for me, which is not a lot for Hervé.
I'm sure it's a lot.
It's not a lot for Hervé, but it's a lot for me. And so, you know, I said, okay, I have to practice what I preach. So let's get in. So everyone who was selling everything, so it would drop in the market. So the Dow was going down, you know, maybe it was over 10,000. It was at about 8,500 or so in December. So I said, well, hey, this sounds like a good time to get in. Jumped in December. By April, I was up maybe $5,000, you know, from that investment. However, through that period from January, February, March, the market kept chugging down. And so it was good for some of us because then I was able to buy low. Could you talk a little bit about the importance of buying low? That this is actually a time to buy, not a time to sell?
Excellent point, Sakina. Here's the thing. Most of investors, the problem that they tend to have is that they wait till the market gets high. That's when they want to buy. It's like, I want to get in. I'm hearing the market's doing good. Market is low, that's when they want to pull out. It should be the reverse. And this is one of the biggest concerns as an advisor that I'm always trying to preach to clients, is that we've got to be able to look at when is the best time to get in, when is the best time to get out. Market high, that's when you want to actually be thinking about taking profits and possibly, scaling back on some of your gains. When the market is low, that is the best time to get in. But for you to having done it, great. I mean,
Thank you.
So you're learning from it. Good.
Yes, I'm learning.
But what most people don't do, though, unfortunately, is do just that. They are going into the market. They are selling out. And when you're selling, that's when you lock in losses. You lock in losses when you win.
That's what I tried to say. You sell, now you took the loss.
Right.
You can never regain
that
that money if you would have just let it
exactly.
stay in the market.
And allow it to let the market do what it does. It came back just the same way that we're seeing the market is coming back right now. That's exactly what's going to happen. And so it goes back again. What's my risk tolerance? How comfortable should I have been even going in the first place?
Okay.
So.
And I think that lends itself to the type of person that is investing, and you hit on this before about
Right.
your risk tolerance.
Right.
But what actually is the profile of someone who should even be in stocks? Because most people who are investing in stocks who actually got that scared over
Right,
3 or 4
okay.
months and took their money out,
Right.
should they have even been in the stock market? I mean, what is a typical stock market investor?
Here's the thing with no typical stock investor. You can be 21, you can be 35, you can be 70. It really doesn't matter. Investors are all different. One investor may think for him, being in the market might be having money to a lot of different institutions, a little bit everywhere. For another person, they just may want to just be in cash with very little bit in equities. The thing is, there's no typical profile. It really goes back to, again, what is it that I'm trying to accomplish in the market here? Is it for wealth accumulation? Am I thinking about retirement? Is this money long-term? Is this money short-term? So it depends on what the individual is looking to accomplish. That really makes a difference. If we talked about purchasing a home. If you're going to buy a home in the next 2 years, let's say, you probably should be in scale. I mean,
You should be in
You
cash.
should be in cash.
I should
and
be
maybe
in cash.
Right,
I
you
have
should
to
be
buy
in
another
cash.
house
You
the
may even
next
be in
year.
some fixed income. But the bottom line is, you really should not be in equities. You shouldn't be in anything like emerging markets or anything like that. So, but however, if your time horizon is long term, then you really should be in those types of investments.
Okay, but if you have, say, $5,000, that's all you have.
Right. Okay.
Should someone run in and say, call you up, Hervé Vixamar, please, 1-800 Hervé Vixamar? I want my $5,000 in stocks. Is that a good move, or are you going to tell them that they should start off with something else?
You can start off with the 5,000, and I try to tell people sometimes you don't even need 5,000 to even start into the market. You can dollar cost average into the market. Start with a smaller number. I think we talked a little bit. You can dollar cost averaging into the market. $100 a month, going over every single month systematically comes out of your checking account and actually purchase maybe mutual funds or an individual stock.
Okay,
And
now
you
let
can do it
me
that
slow
way.
you down for a minute. So a dollar cost averaging, that basically means that you spend, so a stock, and we're not going to say any names because we're
Right,
not trying
okay.
to make the market tumble with this conversation.
Exactly. More important.
So,
Got it.
XYZ company,
Right.
stock is $50 a share. If I put in $25, now I'm buying like half a share. I can do it that way. And then next month I put in another $25, so now I've bought the full share.
Right. Normally,
It sounds kind of like layaway. It's
Right.
like stocks on
yeah,
layaway.
let's not call it layaway.
Okay.
But similar to that. Usually for someone like that, though, I'm going to start them in a mutual fund. It makes a little bit more sense because the mutual fund has a collection of different stocks in there. And so basically your money's being pooled with other investors inside of a mutual fund. So it's easier to kind of start it in a mutual fund to kind of build up that way. Because certain stocks, because of the price of the stock, you can't always get in with half a share or anything because you have to buy it in wholes. So that becomes a little bit more difficult with individual stocks. So in a mutual fund portfolio, it works great. And it does the same thing. So we can still tailor your mutual fund based on your risk tolerance and your
Okay.
time horizon.
Okay. So for those people who are out there now and they have a little bit of money, have a lot of money actually in cash
Right.
because, hey, they just sold
Right,
just
there's
about
a-
everything
right,
last year.
There's a lot on the side.
So they have a lot of money in cash, up from $5,000 to $50,000 maybe in
Right,
cash.
okay.
Why should now be a good time? I know you said all the time is always a good time. That
Right,
sounds nice
right,
and dandy.
yeah.
But check. Right now, the market is at 10,000 plus,
Right,
10,300 something.
Right.
I am kind of feeling like, so now isn't the greatest time? The greatest time was when the market was at 7,600. You know, when the Dow was at 7,600 and the Dow was at 8,600. So now the Dow is at 10,300.
Right.
What do I have to do to get in now? Because everything's getting more expensive.
Actually, things are not as expensive as you may think. I mean, the Dow at the height was at over 14,000 at one point. So we still have some ways to go to even reach our all-time high. So one of the things that you have to look at is if you can get into the market now. Now, there are some indicators that tells you that you really should be thinking about getting into the market.
What are those indicators?
You know, before last year, we were talking recession. We were talking depression. People were really panicking. That's why people really obviously went into cash. But now we're talking recovery. We're starting to see earnings. A lot of companies are doing very well. And obviously the markets are moving in the right direction. So you actually want to be in this type of a market at this point in time because you want to take advantage of any gains that are happening. Because many of the stocks that were at all-time lows last year, you know, so a lot of these stocks haven't fully recovered. So great opportunities right now still exist in the market. Probably some of the best opportunities exist today. So
okay. Are there still, speak a little bit about the target funds. Are they the safest place that you can put your money? You know, if you set a target for yourself, I'm going to retire in 2040, put my money in this 2040 fund or sorts. I mean, are those the safest places that people should go who's still a little nervous?
I have a problem with the word safe, but we'll talk about that.
Okay.
Not the safest place. I wouldn't use the word safe. That's what they are. They're target funds. They're saying that, you know what, my portfolio would start somewhat aggressive if I have a very long-term time horizon. And so if I'm going to retire in 2040, so guess what? My portfolio will scale back all the way till that time. So it keeps getting more and more conservative as you get closer to that target date when you're actually going to use those funds. Now, target funds, you know, they don't have a huge track record like a lot of mutual funds or stocks. So the concern is that a lot of them took a hit as well. They took a hit in the market. Some people did call me, some who may have their target funds inside their retirement plan. And clients call and say, you know what, I see that my target fund is down almost 50%. What should I do? Should I move out of there? But
Did you move out?
No.
Did he sell?
Actually, he did not sell. He felt more comfortable selling a small position of it. But once we understood that the idea was that this target fund is designed for you to be aggressive like this, it's going to see down markets. But because you're putting money in every single month, but guess what? You're also buying the shares inside that fund at a cheaper rate. So we decided that we were going to move a portion to make him feel a little bit comfortable, but the vast majority of his funds actually stayed in the target fund.
Okay. Now you hit on something that's really important, that your client called you, which is one of the problems that a lot of us have. And the fifth key to keeping it rich is to hire professionals. I'm big on hiring professionals. So as you know, I have like a bevy.
Right, you have a bevy.
The insurance people, the investor people, the estate tax people, the regular tax people. You know, this is a bunch of people. Some of the people I talked to said they didn't have an advisor. They just, you know, maybe jumped into a fund. We won't say any names again. But, you know, there are some, you know, over-the-counter funds that you can just, you know, go online and plug yourself into.
Definitely.
You can just start dumping money online. And so they apparently had done this, or that rolled over into some funds that would allow them the ability to actually manage their own account, which is why when they saw the news and the news said things were bad, they said, oh, I'm my advisor. I will now go online and sell all my stuff. How important is it to have an advisor? And I know that this is like such a self-serving question, but
it is. And you know, and I guess I can talk for myself, but I can talk for advisors.
Do you have an advisor?
It's a good point. I personally do not have an advisor, but however, I do consult with other advisors in terms of what I should be, when I look at my own particular portfolio, exactly what I should be doing. Because I realize the key thing, I think, as an advisor, what an advisor does, we take the emotion out of the whole piece of the planning. This is why a lot of people jumped into cash, not understanding the market. One of the things that I did, I called a lot of my clients and go back to educating them. We talked very distinctly about the goals. You still want to educate your kids. You still want to make sure you retire comfortably. We still want to make sure that, you know, we have X amount of emergency funds set aside. Are we still accomplishing those things? The market will do, as I said before, will do what the market does, but the advisor basically helps you stay focused in terms of helping you understand. Because again, it's that all or nothing theory that kind of really hurts people. People don't do well in the market if they're constantly jumping in and out when they hear either good news or bad news.
Very
it's
good
the
point.
one who stays true to the goal in terms of what they're trying to accomplish.
Which is good. Okay, and this is going to be like my last question, and we all really want to know this. So what is in it for the advisor? Like, how do you get paid? Because you look really spiffy and everything. So, if I gave you, my $50,000 in cash today, I want to make
Right.
sure you're not going to take $25,000 and go buy yourself a suit. So tell all of us, exactly how does an advisor get paid?
This is a very good question. I think, sometimes we hear things in the media, and it always may show a bad light to advisors. I think the key thing that advisors can get paid one of two ways. They can do a fee-based or a non-fee-based type of a situation, or a commission basis, sometimes we like to call it. When the advisor is getting paid on the fee, it's something that they're speaking to their client about right up front. A fee could be something for a financial plan. They really want to be able to crystallize exactly what the goals are, crystallize exactly what they're trying to accomplish, and the advisor goes back to his laboratory, he creates a financial plan, and it really helps that person gauge what they want to do. They can actually sometimes take that plan, and they can even take it to another advisor to get it implemented.
Right, which is why they charge them, because they actually crunch all your numbers.
Exactly.
I've gone through this process. I paid about $500 to somebody. They crunch all the numbers, and they come back to me and say, okay, you have about this much discretionary income, and we suggest you put it in this type of fund or that type of fund. And just pay them a flat
fee. And it can even
fee.
be more elaborate than that, because we can talk about the estate planning piece, the tax issues. We can really discuss the person's total overall picture.
For a flat fee, if you want to go that rate.
Exactly.
And then if you don't want to go the flat fee route, which I don't do that anymore.
Right, and you can do a commission route. I think one of the fears for a lot of people is that will these products be going into a proprietary type of product? But that's not always the case. As an advisor, myself included, I do work with people on a fee base or a commission base. When I am looking at a commission base, maybe because of where the person is at this stage, we're still looking at the best possible products to offer them. One of the advantages is that I can look at just about every product that's out there. So whether it be on the insurance side, on the investment side, so I'm not locked into just working with one particular company. And that's important for you as a client to kind of know that you're just not working with just one particular product. So that's a very important piece, because that individual should get the proper service. The whole idea is to be able to bring the best product to the individual based on his or her goals.
I completely agree with you. And I like the whole commission-based piece, because then I know that the advisor has some skin in the game. So if I make money, he make money.
Exactly. Right, exactly. And I think that's a very valid point. So people shouldn't be afraid. I think you just have to be very comfortable with the person that you're sitting with, and be able to feel that you're comfortable, and be able to tell him what's really on your mind. And he's got to be able to reciprocate and give you some good solid recommendations.
Well, I feel very comfortable with you, and I'm glad that you came to talk to me today. We
Always
actually,
love talking to you.
Well, thank you. I did not do a study, but I've done a lot of presentations, and I make reference to a study that was done by someone, and I won't say the name of who did the study either. But what they found was that one of the reasons why people don't invest in the stock market is because they don't trust advisors. And I would have to say that you got to get past that. You don't necessarily have to trust them. You can check them. Call them every day. I call my advisors often, very, very often. So you don't necessarily have to trust them, but you need them before you actually jump off a cliff and sell all of your stocks. Make sure you talk to somebody. So that was our edition of Keeping It Rich with Sakina. I am your host, Sakina Sproul.